Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 4th to 10th of January 2021, and the articles that I've chosen are from Business Time, Hindu, Business Standard, Indian Express, Limit and Financial Express. Let's begin the discussion. The first article is with respect to SEZs and RoDTEP. First and foremost, there is a concept of SEZ as well as Export Oriented Units, EOU. SEZ stands for Special Economic Zones. The concept of EOU was introduced back in the year 1981. This was basically done in order to promote exports from India to the international market. And on the other hand, the concept of special economic zones was introduced in the year 2000, but from 2000 to 2006, this was implemented as a part of foreign trade policy. Government of India basically gave a statutory status to this by passing SEZ Act 2005, and thereafter this has been implemented as per the provisions of SEZ Act of 2005. Now, certain very important points with respect to both SEZs as well as EOU are both SEZ as well as EOU account for more than 30% of total of India's exports, and these also are involved in production, manufacturing, services, etc. have created lot of employment opportunities. In addition to this, another concept that has been mentioned is concept of RoDTEP. RoDTEP basically stands for remission of duties or taxes on exports of products. And basically before RoDTEP, there was a concept of MEIS, Merchandise Exports from India scheme. This was introduced as a part of foreign trade policy, under which Government of India, in order to promote more and more exports, that is specifically merchandise exports, provided export incentives. Now this particular scheme, MEIS, was taken up by USA, and it challenged the validity of this particular scheme at a WTO dispute resolution mechanism. And last year WTO has basically ruled in favor of USA and has asked Government of India to withdraw this particular scheme along with many other export incentive schemes. Now Government of India basically said that from December 31st post this particular date, MEIS scheme has been withdrawn and a new scheme RoDTEP will be implemented. Under the concept of RoDTEP, along with all the other input taxes will be remitted to the producer. But this particular article basically discusses the connection between RoDTEP and SEZs. The article basically says that SEZs as well as EOUs procure certain raw materials or inputs from the domestic market. And when these particular units which are located in SEZs and EOUs procure this particular raw material inputs, they are paying certain taxes, and as per the guidelines as of now, these particular taxes will not be covered under RoDTEP. In simple terms, these particular units which are set up in SEZ as well as EOUs will not be getting these particular taxes that they have paid on their inputs remitted under the concept of RoDTEP. The article basically says that if these particular taxes are not remitted back, then the SEZs or the units which are located in SEZs as well as EOUs will be losing their advantage, and they may think of moving to other countries. That is basically they might relocate their production or manufacturing activity from India to other country. So this is basically what has been discussed in this particular article with respect to SEZ as well as RoDTEP. Now based on this discussion, I have given a question here. Consider the following statements regarding SEZs. SEZs earlier functioned under the provisions of foreign trade policy. Yes, this particular statement is true. Second, no license is required for import. That is basically those units which are located in the SEZs, do they require any license to import any of the material for production as well as export purposes? This particular statement is true. Any unit which is located within the SEZ, they do not require any kind of a importing license whenever they want to import certain raw material, let's say certain component. So both the statements are true. Based on this, right option is option C, both are true. Next article is with respect to e-platform for selling the assets which are owned by Government of India. Now please understand, Government of India on one side has set up huge amount of disinvestment target. To be more precise, for the current fiscal, Government of India has set up a target of 2.1 trillion rupees. That is the revenue that they want to generate by selling the assets which are owned by Government of India in the market. Now, on the other hand, there has been certain issues with respect to selling of these particular assets in the market. Some of the issues which are quoted in this particular article are with respect to the issue with land titles and circle rates of these particular lands that they want to sell off. What I'm actually referring to basically is this. Government of India owns public sector enterprises, and this particular public sector enterprises will have certain assets. For example, land. This particular land could be sold off and monetized to generate revenue for Government of India. This is part of the disinvestment drive, or basically drive of Government of India to sell the assets which are owned by the public sector enterprises to generate certain revenue. In order to achieve this, Government of India specifically has stated that it wants to set up a new platform, basically a new website. MSTC earlier was known as Metal Scrap Trading Corporation Limited. It was set up in 1964 under the Companies Act of 1956. It was renamed as MSTC in 1994. And one more very important with respect to this, MSTC is a Mini Ratna Category 1 company. Now I'll tell you certain points related to the categorization. Just give me a couple of minutes. But more importantly, what else is given in this particular article? Government of India states that using this particular EAT platform, it wants to monetize assets worth 10,000 crore rupees, and this particular platform would be set up in next 1 month and would become operational. And it is likely that this announcement will be done in the upcoming budget, which is scheduled to be announced on 1st of February 2021. Now, to begin with, only assets which are valued above 100 crore rupees will be listed in this particular platform. This will also be co-managed, basically monitored along with DPM, Department of Investment and Public Asset Management. In addition to this, the article also states that the buyers who wish to participate in this particular bidding process will have to be registered with MSTC first. And those particular assets which are not involved in any kind of litigation will be listed in this particular platform and will be auctioned off by the government. These are certain very important points given in the article. Now, along with this, earlier I stated that I'll tell you certain points related to categorization. Now, please understand, the companies which are owned by Government of India are given certain special status. Not all of them, but many of them have been given certain special status based on certain parameters. The categorization are under 3 heads. One is Maharatna CPSEs, second one is Navaratna CPSEs, and third one is Mini Ratna CPSEs. Under the concept of Mini Ratna, again there are 2 categorization, that is a category 1 Mini Ratna CPSEs and category 2 Mini Ratna CPSEs. This is another very important piece of information that you need to remember. So these are certain important points related to the article. Based on this discussion, I have given a question here. Consider the following statements regarding MST. It is a Navaratna company. No, this particular statement is wrong. It is a Mini Ratna category 1 company, that is CPSE. It is functioning under the Ministry of Commerce and Industries. This particular statement is wrong. This is functioning under Ministry of Steel. So both the statements are wrong. Right option is option D. Both are false. The next article is with respect to GST collections. First and foremost, for the month of December, the GST revenue collection has been over 1.15 lakh crore rupees. And this various experts have basically stated is an indicator of economic recovery that has been happening in case of Indian economy after there was a slowdown or there was a contraction in the Indian economy because of the COVID-induced lockdowns. Second very important point. This particular collection comes on the background that in the previous 2 months before December, the collections have crossed more than 1 lakh crore rupees. In this particular financial year, in the first 9 months, the total amount of GST revenue collection has been around 7.8 lakh crore rupees. But out of this particular 9 months, if you take the first 6 months, the total GST revenue collection comes somewhere around 4.5 lakh crore. If you take monthly target collection of let's say 1 lakh crore rupees, there is a shortfall of around 1.4 trillion or 1.4 lakh crore rupees for these particular 6 months or the first 6 months of the current fiscal. But thankfully, after these particular 6 months, consecutively for the next 3 months, ending December, the average revenue collection has been more than 1 lakh crore rupees. Now, various experts have stated this to be one indicator of economic recovery, like earlier I've said. Second, could be because of the demand during the festivals. Third, could be because of certain reforms, certain measures which have been taken by Government of India very recently, which have boosted the GST revenue collection. What I'm actually referring to is with respect to Government of India mandating all the businesses with a turnover of over 100 crore rupees compulsorily getting e-invoices. Second, Government of India targeting certain businesses which are accused of being involved in tax evasion. And third, Government of India targeting certain people who are involved in tax evasion. So these are certain reforms or measures which have basically boosted the tax revenue collection or GST revenue collection of the government for the month of December. Now, in addition to this, another very important point which has been mentioned in the article, which has contributed to higher GST revenue collection, is this. There are certain payments which were pending of various taxpayers, that is basically GST payment which was pending, and the due date was the end of December 2020. And many of these have been done, as a result of which GST revenue collection has been much higher, and this has been the highest GST revenue collection per month. That is basically monthly GST revenue collection. This has been the highest since the introduction of GST back in the year 2017. Now, in addition to this, the article basically discusses if this is true, that is, there is an economic recovery happening which is being stated by Government of India, then the revenue collection should continue on the same pattern in the coming months also. If this happens, then the revenues which are collected by the states as well as the central government because of the GST will be higher. This will provide certain relief for both center as well as the state which have been battling with respect to financial issues. And most importantly, because of the lockdown which was imposed by the government, the GST revenue collection has been much lesser in the initial months in the current fiscal. As a result of this, the revenue shortfall has been very high. If the trend continues, that is a higher GST revenue collection trend continues, then as per the article, the revenue shortfall could be shortened, should be brought down to between 80,000 crore rupees to 1 lakh crore rupees. So these are certain very important points which have been given in this particular article with respect to GST collection for the month of December. The next article is with respect to Government of India proposing to set up a bank to fund infrastructure projects. First and foremost, there is a huge requirement of providing financing for infrastructure in India, and there is a problem with respect to this kind of infrastructure financing, because in case of infrastructure we use a term gestation period is very high. Now, what is the meaning of the term gestation period? In case of infrastructure, gestation period generally refers to the time period which is basically from starting of this particular project to the point where the production has already begun. For example, if I want to develop a manufacturing facility, from which date I start the construction and finally on which date or in which year the production begins, the time that is present between these two endpoints or these 2 points is called as a gestation period in case of infrastructure. So in case of infrastructure, gestation period is generally very high. That is a precise reason we generally say that infrastructure requires long-term loans. And in case of India, there has been certain issues with respect to the institutions which are providing long-term loans for development of infrastructure. Now, Government of India very recently has stated that it is basically looking into a plan to set up a $14 billion bank to fund infrastructure projects. As per the article, it will be provided with an equity capital of 1 lakh crore to begin with. Over a period of time, this particular bank will be attracting investments from other institutions or other investors in the market in line as done by NIIF. That is basically National Investment Infrastructure Fund. NIIF has attracted large amount of investments from sovereign wealth funds such as Abu Dhabi Investors Group, Canada Pension Investment, etc. So basically, Government of India is saying that it will set up this particular bank with equity capital of 1 lakh crore rupees, and over a period of time, it will be able to attract such long-term investors and large investors to provide infrastructure funding in case of India. And not only this, the Government of India stated that the existing India Infrastructure Finance Company, which has a 2000 crore corpus, will also be merged with this particular new bank. So these are certain important points which are mentioned in this particular article. Next article is with respect to MDR. MDR stands for Merchant Discount Rate. Now first and foremost, what do you mean by merchant discount rate? Now understand this. Here is a bank. It has issued, let's say, a debit card or a credit card to its customer. Now this particular customer uses this particular card, let's say at a petrol bunk, and at a petrol bunk, the person who is going to swipe this particular card is using a machine or a point of sales machine issued by some other bank. So have a look at this. Banks are involved in this kind of a transaction. There is a point of sales machine and there is a payment service provider who is also involved in this kind of a transaction. So whenever this kind of a transaction happens, this particular merchant will pay certain charges to this particular payment service provider. For what reason? Because this particular payment service provider has provided infrastructure for conducting the transaction. So this is a basic idea of a merchant discount rate. Now, in the budget which was announced in July 2019, Government of India basically stated that the MDR which is applied on UPI transaction as well as a RuPay card transaction, these charges will be waived off. This was done in order to promote one, digital transactions in India so that tax evasions will be reduced. Second, in order to promote homegrown, that is domestic companies which have generated these kind of technologies such as UPI and RuPay. Now against this article basically mentions that there have been certain concerns which have been raised by these particular intermediaries. Some of these particular fintech companies which are the startup, these are basically saying that if Government of India waives off such charges on UPI transaction as well as RuPay card, then the revenues which are generated by them will get affected. Second, the banks which are involved in these kind of transactions will have no incentive to develop such infrastructure because they do not have any kind of incentives. So these are certain concerns which have been raised by these particular participants which were supposed to get MDR on these particular transaction. Now what is the way forward? What should be done? The article basically says that Government of India, that is basically the respective department, has looked into this and they are looking at the ways to provide compensation to these particular intermediaries who are losing the revenues because of this decision of Government of India. So these are certain very important points given with respect to MDR in this particular article. The next couple of articles are with respect to WTO and India. To be more precise, we will be discussing 3 articles here, and all the 3 articles had appeared in different newspapers but within the same week. First and foremost, there is this particular concept of the trade policy review. Very recently, India's trade policy review was done. Now please understand this. All the WTO members will have to undergo this particular concept of a trade policy review. What is this trade policy review? Basically, WTO will look into the policies of respective WTO members after certain intervals and try to find out whether these particular policies are as per the norms of WTO guidelines or not. Now, in case of the top 4 countries in terms of the economic size, the trade policy review is conducted once every 2 years. The next 16 top countries, the trade policy review is conducted once every 4 years, and the remaining countries, the review is conducted once every 6 years. And in case of least developed countries, there is a different provision with respect to this particular concept of a trade policy review itself. The last time India's trade policy review was conducted was back in the year 2015, and in the year 2019 again one more trade policy review has been done, and very recently the report has been published. Now what are the important points mentioned in this particular review in the context of India? First and foremost, this particular review mentions that the tariffs which are imposed by Government of India in recent times have increased. In 15, these particular tariffs averaged around 13%, By financial year 21, this has increased to 14.3%. If you basically break this into agriculture as well as non-agriculture tariffs, in case of the agriculture tariffs, it has increased from 36.4% to 36.5%. In case of non-agriculture tariffs, that is basically on imports, the tariffs have increased from 9.5% to 11.1%. Not only this, the tariffs in case of India are in the range of 0% to 150%. Now, in addition to this, the article mentions that in case of India, the trade policy measures are used by the government in order to address the domestic market. That is basically to ensure domestic inflation, domestic availability of raw materials, and domestic supplies. The review basically says that the trade policies should be used in order to promote exports, but in case of India, these particular policies are used very frequently to take care of these particular domestic issues. The article also mentions that Government of India should focus more on making these particular tariffs rational, reducing these particular tariffs so that there is certain guarantee with respect to policy of the government, which will basically help in promoting trade between India and other trading partners. Not only this, the article also mentions that there has been a frequent changes in import and export policies of the government. Rather than using this kind of a switch on and a switch off module with respect to exports and imports, Government of India should go for a predictable policy with respect to imports as well as exports. So these are certain very important points with respect to the trade policy review which was conducted very recently with respect to India. Now on the other hand, there is a discussion with respect to India requesting WTO to resolve a public stockholding issue. Now what is this particular idea of a public stockholding issue and why it is there in the discussion? Please understand this. Just like any other country, in case of India also, India provides certain incentives, that is specifically subsidies in the agriculture sector. But in case of a WTO, what they have done is basically with respect to the agreement on agriculture, which India is a signatory or a part of, there is a concept of aggregate measure of a support. That is basically these particular subsidies have been divided into different types of boxes. The important boxes are amber box, green box. In addition to this, there is also a blue box which is part of a amber box itself. Now understand this, in case of amber box subsidies, what they basically say is the aggregate measure of a support which is provided by the government in case of agriculture sector should not be crossing more than 10% of value of production in case of developing countries, and it should not be crossing more than 5% in case of developed countries. Now, in case of green box subsidies, there is no limit on this because these are non-distorting or least distorting subsidies in the market. Hence, any amount of subsidy can be provided. Again, there are certain conditions attached even to this. Now, what has happened over a period of time is Government of India provides subsidies in case of inputs also, and provides subsidies in the form of MSP when it procures at a price from the farmers. Against this particular practice of Government of India, other countries, especially a developed economy such as USA, has been raising certain issues. The USA's contention is that when Government of India provides input subsidies as well as provides MSP, it is basically violating this particular provision under the agreement on agriculture. That is basically this particular limit is called as a de minimis level. So the Government of India is violating this particular 10% ceiling. And against this, USA wants to drag India to WTO, and in fact it has raised this particular issue many a times. So in order to control this particular issue, in order to prohibit this kind of a issue being raised against India or a complaint being filed by a developed economy against India at WTO, in the year 2013, in the Bali conference, Government of India basically raised this particular issue of a public stock holding. That is basically economy such as India needs to provide huge amount of subsidies in order to ensure there is a food security for the people. And in the way they are going to provide this particular food security, they may end up violating these particular norms under the agreement of agriculture. In order to address the concern which has been raised by India, basically there was a concept of a peace clause which was introduced. Under this particular peace clause, it basically states that whenever a developing country violates or basically crosses the threshold level of 10%, then the developed economies cannot file a complaint at W2 against this particular violation. This particular concept is called as a peace clause. Now this particular peace clause has been inserted, but Government of India has been insisting that there has to be a permanent solution for this particular issue of food security or public stock holding. And this again has been raised by Government of India during the negotiations which are being held or deliberations which are being held at WTO. So this is very important article with respect to the relation between India, USA and WTO. And the third very important article with respect to India and WTO is the concept of a developing nation status. Understand this, under the concept of a WTO, the members are given a choice to declare themselves as a developing countries. That is basically a country such as India can declare itself as a developing country under WTO. Same has been done even by China. As against this, USA has been classified as a developed nation. Now, what is the importance of being classified as a developing and developed nation under WTO? Whenever you are classified as a developing country, or when you self-declare yourself as a developing country, you will be given certain exemptions or relaxations with respect to implementation of certain agreements. For example, in case of the subsidies in the agriculture sector, the ceiling limit given for developing countries, let's say for India, is 10%, whereas a developed country such as USA, the ceiling limit is 5%. Not only this, a developing country under the ambit of WTO can provide indirect incentives or subsidies to promote exports. So basically there are certain benefits which are derived by the countries which declare themselves as a developing countries under the ambit of WTO. Now against this particular concept, the government of USA has been raising issues against India as well as China, which have themselves declared as developing countries under the concept of WTO. US's contention is that China and India are not developing countries. They should not be given these kind of exemptions or relaxations under the ambit of WTO. Now, against this, very recently India has stated that we must follow a concept of these developing countries voluntarily giving up the concept of a developing nation status. This is the crux of the article given here. So these are the three very important articles in the context of India, WTO, which were there in the newspapers in this particular time period. Now based on this discussion, I have given a question here. Consider the following statements. Trade policy review is mandated under WTO agreements. Yes, this particular statement is correct. Trade policy review of all the member countries of WTO are conducted annually. No, this particular statement is wrong. So based on this, right option is option A, only one is true. The next article is with respect to concept of a pre-pack scheme. In the earlier videos also we have discussed this particular idea, but very recently Government of India has come out with certain guidelines. So that will be what will be the focus of discussion here. First and foremost, what do you mean by a pre-pack scheme? Understand this, the concept of a pre-pack scheme basically refers to an agreement between creditors, specifically secured creditors, and investors in a particular company. What do you mean by this? Just give me a couple of minutes, we'll explain this. Now, second point, under the concept of IBC, Insolvency and Bankruptcy Code, basically the time limit which has been provided for insolvency resolution is 330 days. Out of 1942 cases so far which have been covered under IBC, more than 1442 cases have already crossed this particular deadline of 330 days. So in essence, Government of India introduced the concept of IBC in order to ensure that there is a timely resolution or insolvency resolution of distressed companies. But in recent years or recent times, what has been found is this particular threshold deadline of 330 days has been breached in many cases. So in order to address this, Government of India has proposed amending IBC and introducing the concept of a pre-pack scheme. Under this particular pre-pack scheme, what happens is, imagine there's a promoter of a distressed company. Now whether before the default or after the default, he can simply approach a committee of creditors and give an insolvency resolution plan. That is basically propose a plan for insolvency resolution. And if it is passed by the committee of creditors, then basically this will be part of a pre-pack scheme. As against the concept of IBC, under which there is a particular mechanism which has to be followed. For example, under the IBC, either the creditor or a debtor has to go to NCLT, file a case. Then the NCLT will appoint an insolvency professional. Then the committee of creditors will be appointed. Then they will deliberate. Then the decision will be made, sent to NCLT. NCLT will take a call and issue an order regarding this particular insolvency resolution. Now, as against this particular process, we want to reduce the time period which is taken for insolvency resolution of this particular company or a distressed company under the concept of a pre-pack scheme. As per the draft proposal which has been put forward by Government of India, the market participants will be allowed to put forward a draft resolution plan within 90 days to the authority, that is NCLT. Then the NCLT will be given 30 days to approve this particular plan. And for this particular resolution plan to be submitted to NCLT, you basically require 66% of the approval of the creditors. As per the draft proposal, to begin with, all those particular companies whose value is between, that is basically the value of the default between 1 lakh to 1 crore rupees will be covered to begin with. After this, all those particular defaults which are over 1 crore rupees will be covered, and then later those particular defaults between 1 rupee to 1 lakh rupee will be covered. In addition to this, the article basically says that even in case of a pre-pack, there could be a liquidation of the company conducted in case when 75% of the creditors decide to liquidate this particular company. So these are certain very important points given with respect to pre-pack scheme. In addition to this, please make a note of this. The concept of a pre-pack scheme was recommended by Sahu panel. Not only this, Sahu panel also recommended that in case of the creditors, especially secured creditors, if they don't recover 100% of their dues, then they must look into the concept of a Swiss challenge model. But final decision will be left with the committee of creditors themselves. So these are certain very important points related to this. The next article is with respect to RBI setting up digital infrastructure fund. What are the important points? First and foremost, earlier RBI announced setting up of Acceptance Development Fund, ADF. This particular ADF now has been renamed as a PIDEF, Payments Infrastructure Development Fund scheme, which is being implemented by RBI. Under this particular scheme, total contribution of 345 crores has been done, and RBI has basically set up a committee to look into implementation of this particular funding. Now, this particular fund will be used to develop payments infrastructure, both the physical payments infrastructure as well as the digital payments infrastructure, specifically in Tier 3 to Tier 6 cities. Not only this, a special focus will be laid on developing such infrastructure in northeastern states also. Out of this particular 345 crores, 250 crores has been contributed by RBI, and remaining 95 crores has come from all the other payments intermediaries who are operating in India. And annually, there will be contribution done by these particular companies or payment intermediaries which are going to use this particular infrastructure. The objective of this particular PIDF is to develop the infrastructure which will help in promoting the acceptance of these kind of payments in these areas. For example, payment infrastructure which will utilize QR codes will be developed or will be subsidized under this. The point of sales machines will be subsidized under this. So this is what is the objective of the digital infrastructure fund which is being promoted by RBI now. Now the focus will be to provide subsidies to those people who are involved in following businesses or in following services. For example, kirana shops, healthcare facilities, public distribution system shops, those who are involved in transportation and hospitality services, etc. And RBI basically says that even under this, the primary focus will be on those particular entities which do not have any kind of a infrastructure to accept the payments as of now. Now, as per RBI statement, annually 30 lakh digital points of transaction will be created under this particular scheme. Not only this, different types of infrastructure will be subsidized at different rates. For example, if it is a physical POES, then the subsidy which will be provided will be 30% to 50%, and in case of a digital POES, then the subsidy will be between 50% to 75%. So these are certain very important points with respect to the Payments Infrastructure Development Fund, which has been promoted or which has been announced by RBI. So based on this, I have given a question here. Consider the following statements regarding PIDF. Funding of 350 crore has been provided by the government for this. This statement is wrong. It will focus on developing payments infrastructure in all the cities. Again, this is wrong. As earlier mentioned, it is between tier 3 to tier 6 cities. Specifically, out of all of this, those particular cities which are classified as a tier 3 and a tier 4 will be getting 30% of these particular devices. Tier 5 and 6 will be getting 60% of these devices, and 10% will be in case of northeastern states. So second statement and first statement both are wrong. Right option is option D, both are false. So these are certain very important articles as well as the questions related to these particular articles for this particular time period. Thank you. Have a good day.